The big six banks just released their 2024 Q3 earnings. We are going to look at both the winners and the losers as we once again get an overall feel for the Canadian banking sector. Hold on to your seatbelts, folks. This is going to be a good one. The Canadian big six banks are the largest by market cap, and they are the core of our financial system. In addition to Canada, they also have a significant presence internationally, and some of those international holdings will more than likely come into play. An ongoing story in this quarter has been preparing for the wave of mortgage renewals that, well, they're going to hit the sector sooner than later. Higher rates will be a shock for consumers, and hopefully less of a shock to the banks if they are ready for them. Loan loss provisioning. That's what we're talking about. As we script this video, the next rate cut should be announced tomorrow just after we filmed. And as it so happens, I got off a little late to filming this one. So that rate cut did happen. And that's our third rate cut in as many meetings. Even with 3 rate cuts, there are still going to be people who lose homes. And the banks are going to feel some of those losses. Luckily, the banks have a lot of money set aside for load losses. Once again, loan loss provisioning, it's going to be a theme with the banks for quite a while. We also did not see much in regard to dividend increases this time around. I really had expected one from Scotiabank, but alas, they did not. In fact, only one of the big six raised their dividend this time around. Speaking of increasing, a sub to the channel is a great way to grow those knowledge dividends. In just a moment, we will look at the main highlights of those 2024 Q3 earnings. Overall, most of the banks performed quite well in the sector, especially when you do take into consideration that they're still adding to their loan loss provisions. I do believe as rate cuts continue, it will benefit the sector, and I am still expecting better quarters ahead. So without any further ado, let's do this. We will start with Scotiabank. So that's ticker BNS. We'll start with their earnings per share. They were expected to come in at $1.62. They did exceed that. They came in at $1.63. So they do get a pass for that. When it comes to their revenue, they were expected to come in at $8.53 billion. Now they didn't quite hit that amount. They came in at $8.51 billion. So they will get a fail for that. They will get an overall fail, but it was really not by much. This one was close. Their current dividends unchanged, $1.06 per share. That works into a 6.303% yield. Boy, I sure would have loved to have seen a dividend increase here on this one. Their earnings are expected to grow by 9.12% over the next year. They do have a fair value of $134.01. So that makes them 49.8% undervalued. If we take a look, though, at their one-year forecast, they are expected to come in at $69.27. So that's only a 3% increase. I kind of feel like that's a little bit low. I think Scotiabank is going to do better. Now, I do want to point out Scotiabank did have some payroll issues, but they were technically Q4, so no real impact here. They also made a big US purchase, which will also impact some of their cash flow in future quarters. Next, we will look at Royal Bank. They were expected to come in with an EPS of $2.96. Wow, they blew that out of the water. They came in at $3.26. Their revenue, they were expected to come in at $14.40 billion. Once again, blowing things out of the water, it's a theme for Royal Bank because they did that again with $14.63 billion. Very easy pass here. Definitely an easy pass. Currently, they pay out $1.42 in dividends per share, so that is a yield of 3.387% and no change to their dividend this time around. When we look at their earnings growth, they are expected to grow by 3.12% over the next year. Their current fair value using a discounted cash flow model comes in at $247.96. So that does paint them as undervalued by 34.3%. That one-year forecast, they are expected to come in at $166.07. So that's only a 1.90%. You do have to consider these forecasts were made at the end of the quarter. So all of the great growth we have seen in that financial sector over the last little bit, it's not really taken into account. That's one of the reasons I think these are on the lower side this time around. Royal Bank simply had a great earnings call. And they are already seeing some of the stabilization that we spoke of last time in regard to the rate cuts. Without a doubt, when we look at the total returns a little later, I'm expecting some greatness from this one. Up next, we have TD Bank. Now, when it comes to earnings per share, they were expected to come in at $2.07. They did miss that estimate. They came in at $2.05, so a fail there. On their revenue, they were expected to come in at 12.81 billion. Oh gosh, they missed that too. They came in at 12.57 billion. So they get an overall fail. Now their dividends, they're still sitting at $1.02 per share. That works out to a 5.053% yield. So there was no change in their dividends. Their earnings growth, though, it looks pretty interesting. They're actually expected to grow their earnings by 17.84% over the next year. Their fair value via a discounted cash flow model, that comes in at $159.64. That puts them as being undervalued by 49.4%. Their one-year forecast, it's coming in at 86.22, which works out to a 6.8% increase in their share value. This quarter, TD did squirrel away $3.57 billion to cover those money laundering fees that are about to hit them. This is going to take a bite out of their performance for sure. In fact, if that money had not been a factor, they would have had a more respectable earnings call. No doubt about it. Up next, we have CIBC. Their earnings per share were expected to come in at $1.74. They blew that out of the water. $1.93 is what they reported. Their revenue, they were expected to come in at $6.28 billion. They pulled off $6.60 billion. So they're doing well. They get a huge pass this time around. Their dividend still sitting at 90 cents per share. That's a yield of 4.571%. And they did not increase their dividend. So their earnings growth, it is expected to increase by 3.34% over the next year. Their fair value via a discounted cash flow model comes in at $139.83. That paints them as being undervalued by 43.7%. Their one-year forecast, $79.65. So once again, I think this is low, 1.10% increase. CIBC looked a lot stronger than last quarter. And with their impressive results, this is another one I'm expecting to have a fantastic total return for this year. Up next with the Bank of Montreal, we were expecting to have an earnings per share of $2.76. Yeah, they didn't even get close. They came in at $2.64. So that's not a great fail there. Their revenue was a little bit closer. They were expected to come in at $8.25 billion, but they still faltered. They came in at $8.21 billion. So they do get an overall fail. Their dividends come in at $1.55 per share. So that is a 5.501% yield. There was no change for them. Their earnings are expected to grow by 11.57% in the next year. That's not too shabby. Their fair value, that comes in at $205.81. That does put them as undervalued at 45.2%. Their one-year forecast coming in at $119.36. BMO missed expectations once again, and they did not have a great quarter. And I suspect they will be bringing up the rear when we look at total returns. Finally, we have National Bank. Their earnings per share were expected to come in at $2.47. They did exceed those. They came in at $2.89. On the revenue side, they were expected to come in at $2.86 billion. They once again exceeded that. They came in at $2.98 billion. So once again, National Bank still ticking along nicely with an overall pass. Their dividends per share, they come in at $1.10 per share. That's a yield of 3.563%. And this is the one that raised their dividends. So they did raise their dividends by 4 cents this time around. Their fair value, when you use a discounted cash flow model, comes in at $219.87. That puts them as being, well, undervalued by 43.8%. Their one-year forecast is coming in at $124.38. So that's just an increase of 0.7%. I really think they're going to completely obliterate that number. National Bank continues to have a good, solid quarter. they are in the process of buying Canadian Western Bank. And those numbers, they're not really impacting this quarter. So we will have to see how that's going to look in the future. So let's check out their total returns for this year. We got CIBC right up there at the top at 29.64%. National Bank coming in second, 27.49%. Royal Bank coming in third, 26.41%. So the top three absolutely blew it out of the water. Bank of Nova Scotia still respectable in fourth at 9.44%. Then our negative team, TD Bank, negative 0.55%, and Bank of Montreal bringing up the rear, negative 8.94%. As a bonus, let's take a quick peek at a few of those smaller banks and see just where they come in regards to the year-to-date total return. At the top of that heap, we have the Canadian Western Bank with a total return year-to-date 71.20%. All right, that looks fantastic, like holy banana bread. But this is driven by the announcement of that national bank purchase. So it is inflated. So you gotta take it with a grain of salt. Number two, EQ Bank, they're coming in at 11.07%. And most of you who love the Laurentian Bank, they're sitting in third at 2.14%. We will be back here again after the next quarter. And well, we're gonna do it all over again. I can't wait as we hopefully start to see more positive growth spurred on by those rate cuts. As usual, if you are interested in any of these bank stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on Harvest Single Company ETFs. Thank you for watching, and I will see you in the next video.